Today I want to talk about the difficulty, why the RBA is having so much difficulty cutting rates in spite of the fact that the big banks continue to forecast that the RBA will cut rates. And in doing that, I want to look at our model of, and talk about our model of Australian inflation and Australian short rates, importantly, and how the components of that model fit together, and why when you look at the underlying relationships between inflation and unemployment in particular in the model, you can see why it is that clever Jim Chalmers is making it really, really difficult for the fundamentals to come about for inflation to fall so that the RBA can cut rates. So when we look at our model of the Australian cash rate, it's still a really good model. Ran it yesterday, and it explains just under 90% of monthly variation since back in the 1990s when the cash rate began for the very first time. And the components in it are, of course, core inflation, not headline inflation, unemployment, and inflationary expectations. And what's really interesting when I look at the statistical tests of the components, for example, inflation and unemployment, and unemployment, is that unemployment is even more important in forecasting what the cash rate will be than inflation is itself. And the reason for that is because of the leading relationship that unemployment has with Australian core inflation. So what I've got in this diagram, which you've got, is the actual data for the last 10 years to the end of December of the relationship between unemployment and inflation in Australia. And you can see that the shape of the relationship is what is called the Phillips curve, that as unemployment goes up, core inflation goes down. It actually, I've shown this with no lag. Actually, there is a bit of a lag. It starts after about 3 or 4 months, but conveniently, you can still see a pretty good relationship between the two variables in Australia if you just show the way it is at the same time. Now, the two parts of the data, or the relationship between these data from 2014 to now that I've tried to pick out on the diagram, is the situation that happens when unemployment is 4%, which is pretty much what it is now and has been for the last few months. Unemployment in Australia has been 4%, which is pretty low by historical standards. Most of the time since of this decade, unemployment's been, 5% or higher. But what we look at is the level of core inflation that you would anticipate would occur if you hold unemployment at 4% is 3.7%, which is kind of pretty much where it is now. Core inflation right now is 3.5%. That is to say, if you look at the last monthly measure of the trimmed mean for Australian inflation is 3.5% and unemployment is 4%. So it's near as damn exactly what you would expect from looking at this data. On the other hand, if you want to get unemployment down to where the RBA target is, which is traditionally between 2 and 3%, now it's 2.5%, they say specifically 2.5%, then what you've got to happen is you've got to get unemployment a bit higher than it is now. And the data of the last 10 years suggests that you've got to get unemployment to 4.6, 4.7%. There's a bunch of data from 2001 where you've got it 4.6%, and there you have 2.5% inflation. So what that really tells you is to get inflation down to the RBA target of 2.5%, you've got to allow unemployment to rise a bit. Not a whole lot, you don't have to hit the economy on the head with a mallet, but you've got to see it rise up from 4% where it is stuck up to about 4.6%, and that provides enough excess capacity in the economy, put downward pressure on core inflation, and then when you look at the data at the time lags, it takes 3 or 4 months, but only 3 or 4 months for that higher level of unemployment to put down the pressure on inflation. And if that was allowed to happen, unemployment was allowed to be 4.6%, it would bring inflation down to 2.5%, and the RBA could cut rates. They could cut rates from 435 basis points where they are now down to the low threes or maybe even the high twos. Probably the low threes is where you'd expect it to go to, about 100 points lower than it currently is. But unfortunately, we have a very clever treasurer, clever Jim. And what he is doing is he is continuing to employ people in the NDIS and other areas of the public sector, the Commonwealth public sector. And because he continues to do that and he doesn't want unemployment to go up before the election, we are stuck at this level of unemployment of 4%. Now, leading indicators like job vacancies and so forth, if you built a model of that, you would expect that we would have already had unemployment higher than that, but no, clever Jim wants to keep unemployment low before the election. So that's the basic problem that we've got, that it is the fiscal stimulus provided by the federal government, which is stopping unemployment falling down to unemployment rising to a level of 4.6%, which would generate a low enough inflation to allow the RBA to cut rates. And so if I put the current levels of inflation, unemployment and inflationary expectations in the model, my model estimate is 4.45%, that's yesterday, and that's 10 basis points higher than the current, the Australian cash rate of 4.35%. So tragically, the RBA is not going to cut the cash rate at the next meeting or anytime soon, or as long as the government continues to maintain an unemployment level of 4%.